Hi, this is Francesco Nagari, Deloitte's Global IFRS Insurance Leader. Welcome to our June 2016 IFRS Insurance webcast. Today's webcast is titled, The ISB Votes on Sweep Issues for IFRS 4 Phase 2 and NIA's Completion. Subtitle is ISB will select the effective date for the new IFRS in Q3. So quite an eventful webcast. The agenda is structured around the usual three items. First, I'm going to give you the highlights of the ISB meeting, which was held last week. Then we will spend most of today's webcast analyzing what the staff papers have been saying, how the ISB members have discussed them, and the tentative decision that they reached. We will then spend a very short time at the end on what are the remaining next steps. The highlights, as I mentioned, this was a sweep issues board meeting. The last public board meeting on the project was, as you remember it from the webcast, in February, when the decision to move into balloting was reached unanimously by the ISB, and the balloting has effectively produced a number of drafting comments. Those drafting comments are the issues that are then captured in these sweep issues papers, which effectively help the board progress in their standard setting work by refining in a public debate certain aspects that would require clarification. So we have the opportunity to contemplate the outcomes of each of these four items. The first one being the CSM unlocking and allocation to P&L, which now is being clarified, must be done on a group basis only. Groups are also going to be open to new contracts, subject to some strict tests, but nevertheless, they are not closed units of account. They are open-ended. Although we will see later on that the open-ended feature perhaps is of limited benefit to insurers. The second sweep issue was around the decision to develop guidance on the accounting between P&L and CSM for changes in the assumptions that respectively relate to current and future coverage periods. So we'll see how that guidance will be taken forward. Third, and this is one of the most extensive sweep issues deliberated last week, the ISB has abandoned the requirement in the OCR solution to use a cost measurement basis in P&L for finance cost and income, and instead they agreed to adopt a systematic basis. This is not just a philosophical shift, it also has some practical implication, and I will explain that later. In addition, they also agreed to simplify the interest expense disclosures in the financial statements. And finally, the ISB has agreed to scope out completely all types of reinsurance contracts from the variable fee approach, both in terms of reinsurance contract issued as well as reinsurance contracts held. The staff will start now producing a new fresh draft, and that is designated to be used for the fatal flow review process that is expected to kick off soon, perhaps next month. After which, in Q3, and so that is from next week, effectively, the ISB will be called to choose the mandatory effective date. And given that there is a summer recess and the ISB doesn't work in August, we believe that Q3 means September. And so in September, that's what we are saying in our webcast, the ISB are likely to choose the effective date of the new standard. Traditionally, when such decision is reached, the ISB has got only 3 or 4 months to go, maybe 3, maybe 2, before publication. So we are clearly looking at a scenario that may make the publication this calendar year, the end of this calendar year, a more likely than not scenario. Well, we shall see. So these are the highlights. Let's now move into a more detailed analysis of the 4 issues, starting from the level of aggregation in measuring the CSM. The first point is the whole staff analysis around the January decision, the way it was phrased, and the outcomes of reflecting on it and effectively picturing the application of those principles. You probably remember from our previous webcast that the level of aggregation was effectively considered for onerous contract testing. But the key principle that the ISB approved in January was that the allocation of CSM to P&L was to be done on a on a contract-by-contract basis, and then allowed the allocation to be done on a group basis, so long as the group basis comply with certain characteristics which effectively were deemed to ensure the consistent application of a contract-by-contract principle. The sweep issue then is whether those effects that come from contract-by-contract versus group allocation should be accepted as the way forward, or whether there should be just one basis for accounting the allocation of the CSM to P&L, and whether that basis and the basis for testing the group for being onerous are the same. The paper that the ISB staff prepared is paper 2A, and I wish you to consider perhaps having a look at it when you have a moment. Considers some simple examples and proves very clearly mathematically that individual contract basis accounting for the CSM would actually produce a different profit signature in the financial statements of the insurance company when you compare with accounting for the same group as expected on a group basis. That analysis effectively shows that you have different outcomes depending on the impact of recognizing lapses in the P&L, whether you do it on a contract-by-contract or on an expected basis. And that is, by all means, without assuming any deviations from what you assumed at the start of the life of the group. The staff concluded that when they actually put forward the proposal in January, which was approved by the board, they did not intend for measurement of individual contracts to give rise to a different accounting when group behaves as expected. And so given that this was the approach, they are now setting forward some recommendations to address that inconsistency. The other point, which was not put forward for deliberations, interestingly, however, it is clearly set out in the paper, is whether you should be able to add contracts to the group in later periods. And the staff believes that an entity should be able to do so, and so that means that groups are open-ended, and they are not, as we interpreted when we explained to you the decision in January, closed units. So this means that you can have a group created in 2015, and then you could conceivably add further contracts sold in 2016, 17, and so on. The contract in these subsequent periods can be added to the group that pre-existed then when two conditions are met, and you will not be surprised to see that they are the same conditions that are set out to create the group in the first place. So cash flows of those contracts must respond in a similar way to the risk variables in terms of changes in key assumptions that will affect amount and timing of cash flows, and have similar profitability. The key point here is that the new contract can be added to an existing group if the similar profitability and the similar responsiveness to risk variables are effectively tested against those two characteristics as the group is reported in the subsequent period, not based on what you had in place in prior periods. Now, this offers a number of practical problems. What if the profitability is subsequently changed? And as we know, the group is defined by profitability at the start, and if a component of the group changes, it doesn't appear that the group will have to be split. So when you have the consideration of an addition to a group, what profitability would you take? The one that has remained perhaps similar to the original one, or the one that has changed, still part of the same group? So there are some very interesting practical points. I'm not sure that this has been fully appreciated. It is important that the principle of open-ended groups is contemplated and effectively approved. But this was not debated. There was no request from the staff to vote on it, although it was presented in the paper in a fairly definitive way, and that's why we feel obliged to report it to you as an important development in the balloting process. The closing comment in the staff paper it potentially can cool our hopes down a little bit in terms of how widely applicable this open-ended feature can actually work, can actually be in practice. And I'm quoting here from the staff paper, they say new contracts will often not meet the criteria for joining the group. So there you go. We have an open-ended statement, which is good news, but it seems to be, as noted earlier in the highlights, subject to very strict and rigorous tests, which may make it effectively fairly impracticable in most cases. But we shall see in due course whether that's the case. Then, after these two pieces of analysis, the staff set out their recommendation. First component of that was the recommendation that the objective for the adjustment and release of the CSM is that the CSM at the end of the reporting period must represent the profit for the future services to be provided for a group of contracts. So that is now being enunciated as clearly as I can frankly imagine, and to me this language is unambiguous. The staff also recommended there is a specification that the group of contracts used for measuring the CSM should be the same as the group used for determining when contracts are honored. So again, another very helpful clarification is one single unit of account to be taken into consideration when the accounting for CSM, both in terms of allocation and in terms of onerous contract testing, is done. Then they also recommended that an entity should measure the CSM by grouping insurance contracts that at inception have a similar response to the cash flows that are affected by the various risk variables created by the contract, both in terms of amounts and timing, and similar expected profitability. And in this sweep issue paper, they actually clarified that the profitability is ideally measured as a CSM over the total expected revenue, the insurance revenue, which is the one effectively inflows less the deposit components. However, the board and staff agreed that as a practical expedient, also CSM over the total expected inflows, expected premiums, effectively would be acceptable to establish the similar level of profitability. And finally, the staff recommended that an entity should release CSM in P&L to reflect the expected duration and size of the contracts remaining at the end of the period in the group. So what you see here is effectively three small changes, fairly important one. The first one is because of the open-ended point, the date in which a policy is sold is fundamental for the definition of a group, but is not becoming effectively a characteristics of the group, because now the group could actually include also contracts sold at different inception date if they pass that stringent set of tests. The second change is that we now have a far more precise definition of what the expected profitability measure should be in terms of defining groups. And then thirdly, we have a confirmation that the runoff, the allocation, has to consider two things. One is the passage of time, which we all knew for a long time, but the other one is the size of the CSM. And so the algorithm and for the group, although it is not listed as one of the criterion for setting a group, de facto, because it must be taken into account in the allocation process, it becomes a criterion for defining the group, and that is the size of the CSM. So equally sized CSM in a group will make it much easier to apply then the straightforward passage of time basis, adjusted for lapses. So that is the recommendation, and in terms of the discussion that followed, there was general agreement from the ISB with removing the reference to individual contracts. That case was put forward in a very compelling way and persuasive way. However, some board members raised concerns that the objective set out between the January and the refinement in June for unit of account could result in thousands of portfolios in many cases, and so they thought that perhaps it would be better to group contracts in a way that is aligned to management practices in the company. Other board members explained that for their perspective, it's important to state that what is intended as similar profitability is quite clearly articulated, because they are concerned about the possibility of having a wide range of interpretations. Ultimately, the ISB accepted that these are elements which will make the unit of account definition a difficult component of the standard, and there will be a lot of pushback because of that. However, they made a comparison which I believe is entirely valid between the banking standard, IFRS 9, and the expected credit loss model that banks will have to apply to several different portfolios of financial assets, and the CSM approach. And they felt that they were compatible in terms of efforts and set of requirements. Therefore, they did not feel that they were putting insurers on an unfair playing field compared to banks. In addition, they were also convinced that they were doing something good for the quality of accounting, and that these set of requirements would only trigger better business practices. So altogether, this mini assessment of the requirements that they were deliberated last week led them to a very strong vote in favor of the recommendation, 11 in favor and only 3 board members against the staff recommendation. The ISB then moved to the second sweep issue paper, which is the changes in the carrying amount of CSM for insurance contracts without direct participation features. The analysis of the staff started by noting that under the general model, the CSM is adjusted for changes in fulfillment cash flows that relate to future service. And that has been one of the cornerstones since the unlocking of the CSM was introduced with the 2013 exposure draft. During the balloting process, some of the board members have raised a concern that these objectives could result in some ambiguity because the 2013 exposure draft described some cases, but did not really provide more guidance beyond the overall objective. And some of the comments also note that that text may actually fail to lead to a clear, common understanding of what changes would adjust the CSM and what would not. That text doesn't really change the substance of the requirement in terms of the exposure draft if it is improved, as long as the objective of distinguishing changes related to future services from changes that relate to current or past services is made clear. In particular, the objective of analyzing experience adjustment and changes in future estimates should not be combined. And this is particularly important when an experience gain or an experience loss may be reported, but the insurer knows that as a result of that, they will likely book a loss or a gain, respectively, in future periods. Everyone within the staff appears to conclude that this would not be a good outcome in terms of faithfully representing the performance in the period, in all the periods. And so because of that, the staff recommended to provide guidance on what changes in the fulfillment cash flows relate to future services and adjust CSM and what changes do not, and therefore we'll have to go through P&L. To do that, they also attached to paper 2B an appendix that effectively showed the text in the exposure draft 2013 and how it would be amended. The debate was then kicked off, and there was some disagreement with the wording to start with, because when there is an event that occurred in the current period that which may result in changes to the estimate of cash flows, these may also result in the opposite outcome, which is too much change will be going through P&L and too little into the current period returns results. So the CSM would then be adjusted for more than it should. The staff recognized that perhaps their initial draft was not ideally targeting this particular outcome, and they agreed that they would actually clarify what is actually meant by incurred claims, because given that is the real event in the period that should always be taken to P&L and not to CSM. And that would be done by effectively revising the wording in respect of experience adjustments to make the intention very clear. There were also some minor revisions to the proposed wording, which the staff agreed to consider, and their job is already done. So I would suggest to all of you to download the revised paper 2B, which you can find in the ISB website, where in appendix, again, you can find the approved text from the ISB perspective. And when this was voted, again, a large majority emerged, 12 votes in favor and only 2 votes against the staff recommendation. Then the ISB staff took the board to the third SWIP issue, which is the one on presentation and disclosure of finance income and expenses. This is quite an extensive SWIP issue paper, and in fact, when you look at the ISB updates that came out on Friday, you see that there are 2.5 pages, more than 2.5 pages of text on the SWIP issues decisions, and this one takes over 1.5 pages for the total. So it's a very long one. So bear with me. There will be a lot of text to go through, but it's important that I take the opportunity to brief you as to the content of this decision, and to do so, unfortunately, we need to produce textually rich slides to convey precisely the messages that have emerged from the standard setting process. So let me begin with the analysis of the staff paper 2C. The first point, which I feel is worth talking about, is that insurance finance income or expenses are likely to have a significant effect. So that's a fairly important statement in the opening part of the staff paper. Given that the discount rate, we all know, is a key, perhaps the most material variable in the new accounting model. That is particularly true for insurers that sell long duration contracts. And so that is also important to refresh our memory as to what insurance finance income or expenses are in the standard. And they are defined effectively as the change in the effect of time value of money arising from the passage of time. So the effectively mechanical unwind of the discounting that is put through in the first initial recognition phase of the contract, and the effect of changes in financial assumptions, namely the current discount rates. Discount rates will then be recalibrated at each reporting date to connect with the new market level of interest rates, and they may go up and down. And these two components, the unwinding and the revaluation up and down, are effectively the total amount that is being discussed in this SWIP issue. These will include the impact of time value of money across all the other 3 building blocks of the model: the present value of future cash flows, building block number 1, the risk adjustment, building block number 3, and the CSM, building block number 4. When we talk about the risk adjustment in particular, and this is one of the key items raised in the SWIP issue paper, because of the decision of the standard setters to leave freedom in the choice of the valuation technique for the risk adjustment, there may be techniques that explicitly take the time value of money into account, but there may also be techniques that don't. And so the standard was felt by the staff should actually regulate what to do in both set of circumstances. Then the staff analysis led to the second part of this SWIP issue paper, which is the decision to guide the application of the LCI solution when you have asset-dependent cash flow contracts. Now, we know that from the decision that the ISB reached last year that they don't want to impose a particular way of presenting the interest expense in P&L when you choose the OCI, but they want just to do it by reference to some kind of a cost measurement basis. And during the balloting process, the ISB members and staff realized that this idea of cost may be conceptually in clash with those contracts that may use a crediting rate to present in the P&L the element of time value of money which is not affected by market interest rate fluctuations, particularly when changes in financial assumptions have a substantial effect on the amounts paid to policyholders. A systematic allocation can be determined, and that can be done in many different ways, as we know from the past discussion that the ISB has had on this topic. This SWIP issue paper points out that many of these ways are actually not cost measurement basis. The amounts, for example, credited to policyholders may be primarily driven by economic factors, and often these amounts would be deemed those for P&L presentations when the OCI solution is adopted. And so placing restrictions on amounts that are going to be credited in a period by stating that there should be compliance with the cost measurement principle could effectively add unintentionally complexity and also create a significant risk of unintended consequences in terms of comparability, or even to destroy the faithful representation of the line items in the profit and loss account. So the staff then considered, is there a reliable and practical method to separate the effect of accreting current discount rates and changes in rates from other factors for contracts with participation features? And the conclusion was no, they couldn't find one. And in addition, rather than specify a detailed disclosure, they felt that with all these possible revisions, it would be perhaps more proportionate for the standards to actually avoid the disclosure of requiring all insurers to break down the total impact of discount rates on P&L, balance sheet, and OCI, and instead to introduce some simplified disclosures targeted to the approach that the insurer may have taken in the application of the OCI solution when there are contracts that are with asset-dependent cash flows. Having done all that preamble and talking about risk adjustment and the OCI solution, then a very comprehensive and long set of recommendations was put forward. So let me start one by one. It will take a few pages to go through all of them, so please bear with me. Recommendation number A is that an entity need not disaggregate the change in the risk adjustment into a finance component and an underwriting component. And B, if the entity doesn't make such a disaggregation, then it should present the entire change in the underwriting result, being the P&L and the CSM. If they do, then they will have to separate the the finance component into the investment margin and only leave the rest in the underwriting section of the accounting model. Disclosure will need to be made as a requirement of the choice made. So it is a disclosure which will effectively be part of the disclosure on the valuation technique for the risk adjustment, where you cover effectively the presentational aspects of that technique. Then recommendation C, if an entity disaggregates between P&L and OCI the effect of time value of money, then the standard should not specify the objective of that disaggregation between P&L and OCI to be done on a cost measurement basis. Instead, it should specify that these will be done by reference to a systematic allocation of the total expected insurance finance income and expenses over the life of the contract. And it goes on then on recommendation D, which says in that context, the standard will provide guidance that a systematic allocation is based on the characteristics of the contract without reference to factors that do not affect the measurement of the contract. And that's a very important point, which will come even clearer when I turn to the next page, and results in the amount recognized in OCI over the life of the contract totaling zero. So we're looking at the total life of the contract, not just the coverage period, also including however long is the claim sending period, the whole period in which discounting is applied for all cash flows. And that has to be proven as an internal measure. Of course, at the moment, it doesn't appear to be a requirement for disclosure of that fact, but has to be proven to be done, bringing down to zero. This is also helping, hopefully, understand how the reconciliation between the P&L in the OCI solution and the balance sheet discount rates will reconcile with each other, a point that a number of actuarial colleagues have been raising over the past several months as unclear from the recommendations and decisions that the SB has reached so far on this very matter. The recommendation then continues on letter E, and the standard should provide further guidance that the insurance contracts where the financial assumptions do not have a substantial effect on the amounts paid to the policyholders, effectively non-par contracts, then the systematic allocation is based on the locked-in discount rate, the one that was the market rate at the point of sale. And for those contracts instead, where changes in financial assumptions have a substantial effect on the amounts paid to the policyholder, then a systematic allocation can be determined in different ways. And the two ways that the standard will illustrate are, one is the use of an effective yield method, that is described as a rate that allocates the remaining revised expected finance expenses over the remaining life of the contract at a constant rate. So you can see this is a catch-up adjustment. is not locked in. So this is going to be reset at each reporting day potentially to be effectively meeting that principle of running down to zero the OCI accumulated difference from that point. Or for contracts that use a crediting rate, effectively use a projected unit crediting rate method, which again was discussed in the 2015 extensive number of papers on this subject. In that instance, when you have a crediting rate being used to determine amounts due to the policyholders in the period, then you can use an allocation that is based on the amounts credited in the period and expected to be credited in future periods. So you effectively take the crediting rate as the driver for what amounts you will be reflecting in the P&L. Finally, recommendation F says that the disclosure will be changed, and the standard will abandon the disclosure requirements on the composition of the interest expense, and instead it will ask the insurer to disclose the relationship between insurance finance income and expenses, i.e. the one that comes from the insurance contract side of the balance sheet, and the investment return on the related assets. So effectively it's a drill down disclosure on the investment margin when you do the OCI solution, and the OCI effectively decomposition between P&L and OCI, and the methods used to calculate the interest expense in P&L, given that that is the all-important driver of the OCI solution, being the OCI amount, the difference between that P&L methodology rate and the market interest rates. So as you can see, quite an extensive set of recommendations. In terms of discussion, was very limited. The presentation and the debate was clearly not extensive, and I presume that the ISB members have used probably their own personal time with the staff during the balloting process to get comfortable with the recommendations that were coming forward in this paper. And there was general agreement, subject to some minor changes in the wording, which I've already taken into account in drafting the slides you've seen so far. So the recommendations you've seen are matching the text that was published in the official decision record last Friday. And so the vote came with a unanimous support for recommendations from A to E. And then the last one, recommendation F, on the revision of the disclosure requirements, 2 board members only voted against the staff recommendation, whilst a majority of 12 came out. This talks about a third staff recommendation, but in fact it is recommendation F. And then we come into the last SWIP issue paper, the reinsurance contracts and the scope of VFA. The analysis of the staff here started by observing that some types of reinsurance contracts might actually meet all of the VFA criteria as currently drafted. A reinsurance contract always specifies a clearly identified pool of underlying items, which is effectively the direct insurance contracts that are insured under it. And so that makes the entity potentially subject to the VFA requirements if the 3 criteria of the VFA are met. And in the reinsurance context, that would mean that the cedent participates in a share of their insured direct insurance contracts, which is often the case. The insurer expects that the cedent will retain a substantial share of returns from the reinsured direct insurance contract, which is also the case in most instances, and a substantial proportion of the cash flows that the insurer expects the cedent to retain are expected to vary with the cash flows from reinsured direct insurance contract, which is also true. So this means that you would have a significant extensive application of the VFA to the reinsurance industry. Now, the VFA was developed to address situations in which the policyholder, rather than the cedent, pays a premium to the insurer and expects to receive both insurance coverage and investment return in excess of the premium paid. On the other hand, a reinsurance contract is not constructed with that economic outcome in mind. The cedent normally pays a premium, but doesn't really generally expect to receive reimbursements greater than the premium paid. And the insurer also does not provide a cedent with a return on underlying items and keep a proportion for itself as a fee. So that logic of the variable fee doesn't seem to be working nicely in the reinsurance context. And also, the profit the insurer earns is not a fee for providing investment management services. It is earned from providing reinsurance coverage in most cases. Because of all these, the staff thought that the board did not intend for insurance contracts issued to be within the scope of the VFA. And so they recommended that not only the issued contracts, but also the held contracts by the cedents should be scoped out from the VFA approach, from the variable fee approach. There was very little discussion at all on that one, and unanimous approval followed to scope out these transactions from the VFA. That was the last of the sweep issues that the ISB voted last week. In terms of the next steps, our last agenda item, the staff is now going to go back to their drafting room and produce a new revised draft, taking into account all of these decisions. And then they will start the fatal flow process. So this will be a small number of selected parties, which will be asked to provide input on how certain sections have been drafted and to help the ISB effectively to improve the quality of the drafting. There may be some further sweep issues to be discussed as they arise from testing and from the drafting process during the course of July and September. Otherwise, the ISB is now targeting to vote on the mandatory effective date at the end of next quarter, so probably in September, and publishing the standard over the following few months. Again, based on past experience, that could be 3 or 4 months later. So we'll see how the process moves forward, whether that is going to be the case. So that's the last of my comments for today's webcast. I would like to end my presentation to you by landing on the last page, where you can see all the different alternative options available to you to remain connected with Deloitte and stay up to date with the final stages of the IFRS insurance standard setting process, as well as the understanding of the practical implications that will apply to your business. And with that final comment, I would like to open the floor now for any questions you may have after the recording has been stopped.